Welcome to Creating Financial Independence for Generations to Come. My colleague Don Ledoux and I are excited to walk through some presentations, a series of presentations around multi-generational wealth transfer and the upcoming estate tax changes. As always, some quick disclosures. As with all planning, it always starts with remembering the end. What are we trying to accomplish here? And it's really easy when we start to talk about multi-generational wealth transfer and taxation and potential taxation changes to get really caught up on the numbers and the tax rates and the exemptions. But it's important to really start with what are we trying to accomplish? What are those core family principles? Is it education, housing, philanthropy, starting a business? As we're starting to think through this transfer of wealth, do we want to give them access to capital, or is it just an income stream? As you start to transfer assets, do you want to continue to have some control over those assets through things like trusts and deciding who should be a trustee and who should have the authority to distribute liquidity out of an estate plan?
In addition to this, the IRS does have some rules that can prevent some strategies from being put into place against high net worth people. So what are they? The current estate rules, and obviously they are Congress taxation, president election dependent, start off with your lifetime exemption. That is the amount of money that you can gift during your lifetime or upon passing without the IRS implementing a 40% estate tax. So in 2024, you can either previously through your lifetime or upon passing as a single person, transfer $13.61 million to anyone you choose. If you have an estate greater than that, anything within your estate upon your passing, the IRS will tax at 40% before the remaining money finds its way to your heirs. Now, if you're married, the number is double. So in 2024, you can pass on $27.22 million to anyone you love during your lifetime or upon passing or combination thereof before the IRS hits you with a 40% tax. Now, when this law was passed with these higher exemption amounts, there was a sunset provision put into place that says in January of 2026, this 13.6 number, which we think will grow in 2025 to around $14 million, is scheduled to get cut in half and then move forward from there. So 13.6 million on to 14 will get cut in half to about 7 million, which is the tax number of 5.6 adjusted for inflation. Again, anything above that number in 2026, you will be taxed at 40%. So if a family desires to do some strategic planning, but waits until January, they could lose 14 million of gifting, and at a 40% tax rate, that's around a $5.6 million tax they just created before transferring assets to future heirs. Now, the IRS does allow you to gift $18,000. That number tends to adjust every few years upwards. $18,000 to anyone you want. You could stand on a street corner and write checks to anonymous people all day long at $18,000 per person until you're left broke, and none of that has to be reported. But the moment you gift $19,000 to somebody, that $1,000 extra amount you donated goes against your $13.6 million credit line, we'll call it. And then we have to keep track of that on an annual basis through an extra 709 tax form filing. Now, the IRS does give us some benefits if upon education or for education or medical reasons, if you wanted to gift someone in excess of $18,000, that does not have to be reported. So if you had a loved one or a friend down the street that needed $1 million of medical care, as long as you wrote the medical bill checks, for the check for the bills to the actual hospital or doctor's office or institution, then you do not need to notate that gift to the IRS. So whether it's education for your kids or for someone else you want to pay for their education, you can exceed the $18,000 limit without having to file a report for it. Now, one thing additionally, the IRS allows that in California, if you have assets inside your estate, such as we'll call material items, whether it's stock, homes, other or business stock, if you have that, whatever the basis is in that stock or asset, when upon your passing, you get what they call a step up in basis. So if you paid $100,000 for a home and upon your passing, it was worth $3 million, the IRS then treats that you paid for the house $3 million, so your loved one or your heirs can sell it capital gains free. Now, whether it falls into the estate tax is a different story, but as far as the asset themselves, they get a step up to the date of death value as if that's the price you paid, and we figure out the estate from there. You can go ahead and give assets away while you're living. Some clients will give away corporate stock, investment, real estate, etc. But when you do that, the asset will transfer to your heirs or to your loved ones with the basis. So again, if you paid $100,000 for your house in the 60s in Danville and it's worth $3 million today, if you gift that asset to the kids today, it'll use $3 million of your exemption, but they're going to take the $100,000 basis. So when they sell it, they'll incur the taxes, whatever the tax law is at that time, on that $2.9 million gain. So something to think about that on when you strategically think about gifting assets is when to do it, how to do it, because that basis will carry on.
Now, we like to think about this idea of transfer of generational wealth as a process. And again, it's going to start with an understanding of what do you need to live the desired lifestyle that you want to live. Again, we get driven by taxes and exemption amounts, but it really starts with making sure that you can live the desired lifestyle that you want. You've worked really hard, you've made sacrifices for decades on end, and we can't have a couple guys come in here and say, okay, time to give away $25 million to the next generation that you worked really hard to accomplish. So we need to first make sure that you've got the cash flow and the liquidity that you need to do everything that you want to live during your lifetime. Then we start to get to the second level of priorities, which is the end desired outcome for the family. Is that assets and liquidity that the kids and the grandkids can live off of? Is it there as a backstop for them? Is philanthropy start to come into play for your family? After we've worked through the desired outcome, we now need to look at the specific assets of the estate. And as we like to say, not all assets are created equal when it comes to estate planning. A single family home that you're living in is different than an income producing piece of real estate. A business that you're active in is different than a passive investment in a publicly traded company. And so we really need to look at the totality of the estate to figure out, if we're looking at doing some gifting, what really are the most efficient assets to start giving during your lifetime. Then we've got some tax implications, and we've got a specific slide that speaks specifically to this, but there's a lot of different variations of tax to be aware of. It's not just the estate tax that we need to be sensitive to. Do we want to have any strings attached to those gifts after they're made? So we work with a bunch of type A entrepreneurial individuals, and the idea of giving away assets with no control on the assets that they work so hard to accomplish is a tough pill sometimes for the parents' generation to swallow. So do we want to structure the gift in a way that we still have some control over how those dollars are used? We'd hate to see you work really hard to accumulate some assets, you give it to the next generation, and then you're upset about how the next generation is treating those assets. Talking about those types of things first really helps. And that lays into that last part of the process, which is the family meeting. And talking to the next generation about what your priorities are, what it took to accomplish what you've accomplished, what your expectations are with that wealth moving forward. The more of this stuff that we get on the table, the better. Sometimes it's prudent to share the actual numbers with them. Sometimes it's prudent to just talk about things conceptually, but communication is really, really important on both sides. We hear more and more often from the next generation after they've received a gift, there's some confusion on what they're allowed to do with that money. So if we're able to communicate with them effectively on the front end around, here's what we'd love to see you do with this gift that we've been given, that really helps them in their decision-making process on what to do with those funds moving forward.
Yeah, Aaron talked about liquidity. What it really comes down to is retirement or moving on in life is more of a cash flow issue than an asset issue. People want to live their desired lifestyle. We like to figure out how much cash flow that takes to go on and do what you want to do. We also have times for business owners have to figure out what business expenses was the business picking up. So we make sure that however we strategically move the pieces, that your lifestyle and everything you want to accomplish continues on. You have liquidity for the unexpected. When it comes to homes and vacation properties, a lot of times there's generational properties, say in Lake Tahoe. and families want to pass on those assets to the kids because they want them to hold on for a long time. We have to think through, because if you pass on a $3 million home in Tahoe to the kids now have to pick up the fire insurance, and that's obviously been a challenge lately, but any maintenance and upkeep, property taxes, that they, especially if they got reassessed, and the lack of deductibility of those things. So we have to really analyze, when you hand a nice asset to the next generation, can they afford to maintain it and keep it? And then we always support you spending all the time, money you can on family vacations, making memories, things that matter to the generations in the future.
Now, again, as we think through that desired outcome for the family, it's important to think about what's the priority or the purpose behind the wealth that you've created, and being very clear about what that looks like. It's a big first step to think about giving away some assets to the next generation. And then that next step in that process is to think through, if you're going to make this gift, how would you like to see these assets used again for that next generation? Is it to help kids and grandkids buy a home? As Don mentioned earlier, that tends to be the kind of first priority that parents have. Just important to think through giving somebody assets to use to buy a home that come with property taxes, insurance, maintenance. Sometimes can be a challenging thing. You feel like, wow, I just gave my kids $2 million. They've got a home free and clear. Why are they still asking me for money? Well, they got $25,000 in property taxes that they didn't have before, insurance, maintenance on the home. Some of those things can really add up. Is it to start a business or maintain a business, right? A lot of folks have built wealth by owning their own privately held company. And so there's an entrepreneurial desire to help the future generation with getting those businesses started. Is it education for future generations? Again, this is a unique gift because, as Don mentioned earlier, if you fund some of those education things direct, you don't have to use your lifetime exemption to actually fund those education gifts. So thinking through how much of a priority that is important. Do you want to help supplement their lifestyle, work with purpose? This is a really push-pull thing that we see a lot of wealthy individuals struggle with, is a desire to help their kids live a better life than they maybe could generate on their own, but at the same time not enable the kids to not be productive members of society, right? So how do you give them enough and distribute the money from the trust in a way that allows them to help support their lifestyle, but not necessarily make them an unproductive member of society? And then how do we create some financial independence? Again, the ability to decide to work or not, but have the resources to do what you like. And then charity. Again, what are the important organizations that you guys are all involved with within your family, and how would you guys like to see that perpetuated for generations to come?
One of our biggest challenges with families, high net worth families that have multiple heirs, is that not all assets are created equal. Inside your estate, you'll have some liquidity, you'll have some assets that drive income, there'll be expenses tied to the estate. But one of the larger challenges is when a family owns a business and maybe some real estate, and they're trying to figure out, how do we equalize this estate? How do we keep the family peace after we're gone? And the challenges arise if you have a business that one or more kids are working in and one or more kids are not working in. One or more kids have the capability of running the business, others do not. Businesses tend to sell at 5 or 6 times cash flow. Real estate, if it's selling at a 5 cap, is selling at 20 times cash flow. One might be easier to maintain, real estate. One might be harder business, but you can make more money. So there's some jealousy that can arise inside there. Additionally, we have to make sure that the kids that can rise up through the business have the capability of running the business for future generations too, when mom and dad are gone. So some complexity between the assets of business and real estate, who to leave it to, and how to keep the peace among the heirs based on the jealousy of what something is worth and how much cash flow and profits another one might generate. Additionally, when you transfer assets, whether it's business stock or real estate, we want to make sure that the kids are going to keep it for the long run. Now, this is gifting while you're alive. We want to make sure they keep it for the long run because, again, your basis goes with it. So if they're going to sell that vacation home 2 years later because they cannot afford it, or if they're going to sell that business stock because they want to versus an acquisition, an unforeseen acquisition, we would rather you keep that asset, sell it, pay the taxes, and transfer the after-tax money to the kids and use less of your exemption. So we want to understand your game plans as well as the kids' willingness and ability to maintain and run that asset, to have the benefit of that asset being outside of your estate and growing for another generation. Additionally, when given real estate, there's obviously or often a property tax reassessment. In future presentations, we'll talk about maybe transferring that real estate to an LLC and minimizing some potential property tax reassessment.
Everybody's favorite topic, taxes. And estate taxes is kind of the major focus of this presentation and this idea of multi-generational tax planning, but there's multiple levels of taxation that we need to be aware of, right? We've got the 40% federal estate tax on gifts over that $13 million threshold for 2024, set to get cut in half at the end of 2025. So we're in a 18-month little runway on that piece. California currently does not have an estate tax specific to our state, though there are many states that have them. And if we make some assumptions, possible California comes around to one over time. There's also something called a generational skipping transfer tax. So if you say, great, I'm going to go ahead and skip my kids and go right to my grandkids with this gift so that my kids don't have an estate tax liability, you have some room to make that GSTT transfer. But if you're over that $13 million limit, you can also trigger some GST tax. We've got capital gains tax to consider. As Don mentioned, when we give something while we're living, we transfer our basis over to our kids. If they turn around and sell the asset, yes, we avoided estate taxes, but they triggered capital gains tax. We're kind of in the same spot. Was that really a beneficial gift? We've got income tax, and this is a really fun one because there are ways to actually structure the estate and the trust planning where you can make a gift of assets to the next generation, but actually pay the income taxes associated with those gifts for generations to come. Sounds like a really bad deal for you as the grantor, the one making that gift, but it's an unbelievably powerful tool from an estate planning perspective because you covering their estate taxes, if done appropriately, is not considered a gift. So it allows you to maximize that $13.6 million lifetime exemption and make gifts in perpetuity moving forward, right? We all know how much of a pain paying income tax is. If you're in a position where you have the liquidity and the income to cover your taxes for the kids' generation, really powerful technique. We got property tax challenges. Obviously, they've changed the rules a number of years ago. They could potentially continue to change rules moving forward. But anytime we're moving real estate around, we got to be aware of any property tax issue. There's trust tax rates. So if you leave things in trust for kids, it's a different tax rate than the individual. And then again, as I alluded to earlier, who pays the tax? Is that paid by the kids? Is that paid by the trust? Is that paid by you as the individual that made the gift to the trust? There's a number of different decisions to be made. And we've got to look at the totality of taxes and not just be hyper-focused on estate taxes, because there's a number of places where we need to be aware of potential tax traps as you work through this planning.
We get often asked about how can you control what future generations do with the money you've earned or assets you've earned and pass on to them. So there are ways that you can create rules on when your kids and future generations can actually access the money. You can decide if they are in control. You can put trustees in control. You can have percentages, age bands, matching income. If they're out earning an income, you can have the estate match it so that they do not become trust fund babies. You can do it for your kids, future generations, et cetera. So we help people open and expand the possibilities of what they can do to not enable future generations to financial ruin, but empower them to do great things. And that's a big thing on education, that sometimes people want to skip their kids and go to their grandkids. But if the high net worth families and us do not do a good job of educating their kids on how to handle money, then the future generation and grandkids lack that education as well. And there's a higher probability of the money causing challenges for loved ones down the road. So we like to jump in, hold family meetings, and help educate the next generation about how Wall Street works, how money works, tax laws, et cetera, so they can pass that on down to their kids. Sometimes families say, love my kids, but I want to have a trustee manage the assets to be the one, because I don't want to pick the oldest sibling and have the two other siblings fight with them about distributions. We want to take that control away from the kids, so they'll hire a trustee, whether it's an attorney or an institution, to act as the person that responds to monetary requests versus siblings going at it after mom and dad have passed. And then additionally, separate property and bloodline trust, if families want to pass on assets while they're living or once they've passed to their actual siblings that or to their kids that might be involved in a marriage, you can pass those assets directly to your child in a separate property trust, or what we call bloodline trust. And if something tragically happens to your child, but your grandchildren are alive, that those assets will continue on down in trust for your grandkids, bypassing the spouse. And we often see this in younger couples, older couples that have been around forever. The parents, believe they're together and have the best interest of the kids. It's all good. But if you're in your 30s and you're going to leave $20 million to your daughter, and you think the son-in-law is great, but if something happens to your daughter, he can get remarried and go live some other life, and you want to make sure the money gets to your grandkids, we create these bloodline trusts to accomplish exactly that.
And Don kind of teed this up, the idea of a family meeting. And it's really, really important to discuss and communicate with the next generation. We're analytical in nature, and it's really fun to strategize on mitigating taxes and how do we, move the pieces around. Sometimes the most impactful parts, though, of the conversation is where you get an opportunity to teach the kids and really share with the kids your belief systems around money, whether that's, the importance of liquidity or managing debt or taking risk or not taking risk. It's the ability to multiply the wealth that you've created for the next generation by teaching them what to do with the money. It's one thing to hand them a nice nest egg for them to try to extrapolate and grow over time. But if you can really share with them some of the principles that you have used throughout your business career to create the wealth, that's oftentimes way more valuable even than the dollars that are left behind. And again, helping them understand what are the priorities that you guys have as a family, what are your belief systems, what's the expectations for the next generation, right? I want to make a gift to you. I'd love to see you compound this wealth. I don't want to see you turn around and buy a fancy car the next day. Or if you don't care about those kind of things, great. Let them know that it's okay to spend money on some extra fun things in life because that's what the money's there for. Again, being really clear about what those expectations are is really, really important. The other thing, and Don also kind of alluded to this earlier, not all assets are created equal, and helping everybody understand the differences between business and real estate and stocks and bonds and cash. None of them are necessarily better or worse than the other one. There's always benefits and drawbacks to each of them, but helping everybody understand what does it really mean to own a privately held business. And when the economy turns, you have to make tough business decisions and sometimes lay people off, or sometimes you're the last one to get paid. That's a different relationship with money than a stock and bond portfolio or a leveraged real estate portfolio versus a portfolio that's just generating income. Just important to really start to talk to the next generation about that, because you started from X and grown your wealth, generationally over decades, right? They're starting with a big nest egg from the start, and they didn't learn some of those core principles that you learned when you were just starting with your first dollar, trying to turn the first dollar into the second dollar. So let's try to teach them how to fish, really focus on those core principles and involve them in the conversations around how do you make decisions on the assets that you've created. So we're going to wrap up today's conversation. Today was meant to be kind of a precursor to a series of presentations where we're going to try to drive into a lot more detail about some of the upcoming opportunities or things to think about as you start to consider multi-generational wealth transfer planning. We do have an estate tax rule that's sunsetting at the end of 2025. So we're in a unique spot with about 18 months to go to really work through this planning. We can't stress enough the importance of giving yourself time to work through the plan. It tends to take the parents' generation some time to digest the idea of giving away north of $10 million and how best to go about doing that. Estate planning attorneys are also going to be swamped come October, November, December of 2025. If this rule does sunset, they're all going to be running around trying to do stuff at the same time. You don't want to be in this rat race trying to jam through a plan that has multi-generational implications for you and your family. So give yourself some time. If you have questions, please reach out to us. Happy to be a resource. And we look forward to further education in the future.